Okay, so we're gonna get started now. So this is day one of the 2-day masterclass on changing ownerships. What will we do? We'll have a very short session today. It's not gonna be more than an hour, okay? So probably will be in about just before 2. What we will be doing, we'll go a high-level overview on the 4 different scenarios where change in ownership can happen, okay, or what you mainly get tested on. There's not only 4, but we will cover the 4 main ones. Then tomorrow, we will do one of the, we'll choose one of them and do a question on it. So, so that we will do. So I'm gonna just give you a quick high-level overview, probably be 10 minutes per section, and then just to give you a thinking approach as to how to actually go about doing the question, okay? Or think through a change in ownership. It is going to be very, very important that you can actually think through a change in ownership type of question. And what's also going to be important, you have to know your normal groups in order to deal with a change in ownership, okay? So change in ownership brings in normal groups, just a one added complexity that there is a change in ownership that happens during the current financial year. So just be aware of that, okay? So what is going to happen is that you will have a situation where a company, the parent, has already has an interest in another company. And then during the year, they will either get rid of some of their shares, dispose of some of their shares, or acquire more shares. By them disposing or acquiring shares, that would result in the interest in the company changing. And that is what change in ownership is all about. So the question would be, how do we account for a change in ownership? That's going to be the big question. How do we account for a change in ownership? Basically, it all comes down to the objective of financial reporting. The objective of financial reporting is to provide users of financial statements with financial information that is useful for decision making. So one of a complete set of financial statements includes your income statement, your balance sheet, your cash flow statement, your statement of changes in equity, and other things as well. Now, our job as a financial accountant is to prepare financial statements. So when there is a change in ownership, we need to know how does that impact the preparation of our financial statements. So that's basically what what we're going to deal with over here. So the main things you're going to have to deal with is, 1, to prepare a statement of changes how do you call it now? You have to prepare a statement of profit or loss and other comprehensive income that had a change in ownership. You're going to have to prepare a statement of financial position that had a change in ownership. You'll have to prepare a statement of changes in equity that had a change in ownership. Then, 2 further aspects you must be able to do. You'll have to account for any journal entries, and you have to do any calculations. So any combination of that can be the required, any combination. You're going to need to be able to do calculation. You're going to need to be able to do journal entries. Now, when it comes to the statement of profit or loss and other comprehensive income, what you're going to have to think about is always look at your financial year. You're going to have the beginning of the financial year, and then you're going to have the end of the financial year. Somewhere in between, there may be a change in ownership, or there may be 2 or 3 change in ownerships. Doesn't matter. Okay, but we'll deal with 1. Our explanation will be based on 1 change in ownership. So during the year, there will be a change in ownership. So the big event is that date of change in ownership. You will have to ask yourself, what happened at that date? The question you need to identify is, as a result of the change in ownership, what is the status of, what is the nature of the investment before the change in ownership, and what is the nature of investment after the change in ownership? That is a critical question. What is the nature of the investment or the type of investment before the change in ownership, and what is the nature or type of investment after the change in ownership? Now, when you look at the income statement records financial information for the period under review. For our purposes, the period under review is a full financial year. So when you prepare the income statement, you're preparing the profit or loss and other comprehensive income for the year ended. So therefore, you have to know before the change in ownership, what do I have? And after the change in ownership, what do I have? So let's say before the change in ownership, I have an IFRS 9 investment, then you account in the income statement as per normal. But if after the change in ownership, you have a subsidiary, then that means after the change in ownership, you will have to consolidate. That means for the period after the change in ownership, you need to bring on 100% of the income and expenses of the liability, of the subsidiary on a line-by-line basis, just for that period. So that's important to take note. So the question, when you deal with the income statement, you ask yourself, what was before and what was after? And the income statement needs to be treated based on what you had before and what you had after. So in some cases, before you had a subsidiary, after you had an IFRS 9. Before you had an IFRS 9, after you had a subsidiary. Before and after you have a subsidiary. That all impacts how you account for the income statement. Very important. So it's more the thinking as opposed to getting lost in the detail. Get the thinking right. And then tomorrow, when we work through a question, we will be able to work through the detail because in our mind, we know what we are looking for. We know what we are doing. So before changing ownership, what do I have? After changing ownership, what do I have? That is your thinking when you're looking at the statement of profit or loss and other comprehensive income. When you look at the balance sheet, the statement of financial position, when you look at the statement of financial position, the question you need to ask yourself is, at year end, what is the type of investment? What is the nature of investment? If I have a subsidiary, then that means the balance sheet needs to represent 100% of the subsidiaries, assets, and liabilities on a line-by-line basis. Why? If you have a subsidiary, you need to consolidate. If at year end, the type or the nature of the investment is a normal investment in terms of IFRS 9, then all I will see on the balance sheet is a line item called investment in equity instruments. Okay, so that is, you must get to that level of thinking now. Okay, so when you see a change in ownership without looking at the details, when I say the details, I'm meaning the numbers. Without looking at the numbers, you must already have a picture in your mind of how the income statement will look and what it will include, and how the balance sheet will look and what it will include. So if at year end, I have a normal investment, my balance sheet will only have the parent, and it will only have a line item under non-current assets or even current assets, a line item called investment in equity instruments. But if at year end, I have a subsidiary, my balance sheet will be 100% of the parent and 100% of the subsidiary, assets and liabilities on a line-by-line basis. I already have that picture. I don't know the exact numbers, but because I have that picture, I will be able to pick up the necessary information that I need. So very important, before you jump into the details of change in ownership, get that big picture overview. That is the balance sheet. Now we come to the equity statement, statement of changes in equity. The statement of changes in equity is basically a reconciliation of opening and closing balances of all equity balances. So the statement of change in equity basically explains to the users of financial statements. It explains to the user of financial statements how every equity balance on the balance sheet went from the opening balance to the closing balance. That is what the equity statement represents. It's an explanation, a numerical explanation of how the opening balance went from the opening balance to its closing balance. Now, your typical equity balances in a group situation is share capital, retained earnings, revaluation surplus, mark-to-market reserve, NCI. Okay, so your typical equity statement in a group: share capital, retained earnings, revaluation surplus, mark-to-market reserve, and non-controlling interest. Now, in a group situation with change in ownerships, your equity balances may include a column or a balance called change in ownership. Now you need to know when that column is required and when that column is not required. It all depends on the type of change in ownership. If you have a change in ownership where before and after the change in ownership, you have a subsidiary. So before the change in ownership, you have a subsidiary. After the change in ownership, you have a subsidiary. So that means there's no change in the nature of the investment. That implies that it is a transaction with the owners. Who are the owners? The owners are the parent and the NCI. So basically the NCI and the parent transacted with each other. It just increased or decreased their interest, but before and after, the parent still has a subsidiary. That transaction is considered a transaction with the owners. When you have a transaction with the owner, it is only in that instance will you have an equity balance called change in ownership. When it is not a transaction with the owner, meaning before and after it is not a subsidiary, maybe before it was a sub and after it was an IFRS 9, or before it was IFRS 9 and after it was a subsidiary. So as you can see, before and after it is not a subsidiary. Once it's a subsidiary, the other time it's not. So in that case, it's not a transaction with the owner. So you will not have the column called change in ownerships. So you will only have the column change in ownership when you are transacting with the owners. So that is when the parent is transacting with NCI. And the only time that will be applicable is when before and after the change in ownership transaction, you are a subsidiary. Very important, okay? So that you must just be aware of that. Now we come to the big part, the big change of events. The big change of events is the date of change in ownership. So the typical 4 scenarios are as follows. In no particular order, but I'll just go in this order. Before, you're an IFRS 9 investment. After, you are a subsidiary. The second one, before you are a subsidiary. After, you're an IFRS 9. And then 3 and 4 is the same. Number 3, you are a big sub, you went to a small sub. Number 4, you are a small sub, you went to a big sub. Same thing, just the way it's going, okay? So you need to know the big change of events and what are the journal entries that will come into play. So if you know the journal entries that will come into play, that will help you to prepare your financial statements. So now we'll give you an example. We'll explain we'll go into a little bit detail of the various changes and the journal entries that will that you'll have to do. I'm not going to do the journal entries, I'll just discuss it and explain it. Tomorrow, when we do a question, we will go in a bit in further detail. So, the first one, we said it was a IFRS 9 going to a subsidiary. Okay, so in IFRS 9 becoming a subsidiary. So let's assume you had a 10% interest, IFRS 9, and now you acquired a further 50%, which gives you a 60%, and as a result, you gain control. So you must always look at it from the two separate, you must look at it from a group perspective, and you must also look at it from the parent's separate trial balance. So when you have an IFRS 9, you have a 10% interest, and you acquire further 50%, and now you have control, so you have a subsidiary. So keep in mind, your initial interest is 10%. You acquire a further interest of 50%, which gives you a total interest of 60%. Okay? Now, in the parent's separate financial statements, in a separate trial balance, they would have an investment in equity instruments, 10%. Then they acquire a further 50%. So what they're going to do, they're going to say credit bank for whatever they paid, and they're going to say debit investment in whoever the company is. So now it's a subsidiary, so it's an investment in subsidiary, whatever they want to call it. So they're only accounting for that further 50% purchase. From a group perspective, it is slightly different. From a group perspective, it is slightly different. What is the group going to do? From a group perspective, they're going to do the following. When there is a change in ownership, so if you read IFRS 10 carefully, they'll tell you that when IFRS 10 tells you that when there's a change in ownership, and that change in ownership results in a change in the nature of the investment. Another way put, if that change results in a change in the type of investment. So for example, a change in the nature of investment or a change in the type of the investment is where an investment goes from IFRS 9 to sub or sub to IFRS 9. The nature of the investment have changed. So from a group perspective, if a change in ownership results in the change of in the nature of the investment, this IFRS 10 says that you are deemed to have disposed of your original interest. What was your original interest? 10%. Now take note, what did the parent do in their separate financial statements? All they did was account for the further 50%. They did nothing with the original 10% because they don't have to do anything with it. They have it. They just acquired a further 50%. So in terms of economics, that's what happened. You only acquired a further 50%. From the group perspective, they know you only acquired a further 50%. But because this further 50% resulted in the change of the nature of the investment, IFRS 10 says the following. When a change in ownership results in the change of the nature of the investment, then you are deemed to have disposed of your original interest at fair value and reacquired it at fair value. So what they're saying, they know you didn't really sell it, but they are telling you you are deemed to have sold it. So we will sell it, get rid of the investment at fair value, and then immediately when we sold it, we buy it back. Why is this important? Because our consideration now is no longer only the 50%, our further acquisition. Our consideration is two things. Our consideration is the further purchase of 50% plus the deemed reacquisition of the original interest at fair value. So that's important to understand. Remember, when you went from IFRS 9 to when you went from a normal investment to a subsidiary, at the date of change, you gained control. Because you gain control, that means you, for the first time, you gained control. When you gain control for the first time, what does that mean? You have to apply IFRS 3. IFRS 3 says that you need to do 4 things. You need to identify who is the acquirer. Now, that's not our problem. That's easy for us. The second thing you need to do is to identify the date of acquisition. Once again, that's easy for us. I don't test us too hectically on that. The third thing you need to do, you need to measure assets and liabilities at fair value. And the fourth thing you need to do is to recognize goodwill. Now, to get the correct goodwill calculation, your consideration needs to be correct. So your consideration is now 2 things: the 50% further acquisition plus the fair value of your original 10% interest. So that's very important. So when you go from IFRS 9 to a subsidiary, it results in a change of the nature of investment. That change in the nature of the investment caused you to gain control for the very first time. When you gain control for the very first time, you need to apply IFRS 3. And one of the key components of IFRS 3 is that you have to recognize goodwill for the very first time. So to get the correct goodwill amount, you need the correct consideration, you need the correct NCI, you need the correct fair value of net identifiable assets. So therefore, previously, your consideration only had what you paid for what you acquired. Now, your consideration includes an additional aspect, what you pay for what you acquired, plus the fair value of the original interest. Very, very important. So the easy part over here is that your journal entries at the date of change is basically your at acquisition journal entries. So take note, your journal entries at the date of change is simply your at acquisition journal entries. Why does it make sense? Because this change in ownership resulted in you obtaining control for the very first time. As a result, that becomes your acquisition date. As a result, you need to apply the acquisition date pro forma journal entries. Okay, so that is that for the first one. The second one is where you go from IFRS 9, where you go from a subsidiary to IFRS 9. So what is happening? For the first part, before the change in ownership, you are a subsidiary. That means for that period in the financial, in the income statement, you will have to apply consolidation. That means you are bringing on 100% of the subsidiary's income and expenses on a line-by-line basis. But then what happens? At the date of change, you become an IFRS 9. What does that mean? That means you have lost control. When you lose control, you can no longer consolidate because you are no longer a subsidiary. Because you are no longer a subsidiary, 2 things you have to get rid of. Number 1, 2 things you have to get rid of that is specific to a subsidiary. That is goodwill. You have to get rid of goodwill. You can't have goodwill if you don't have a subsidiary. So you have to get rid of that. And the second thing, you have to get rid of NCI. You can't have NCI if you don't have a subsidiary. So at that date, what you're going to do, so in the first example, where you went from IFRS 9 to subsidiary, the date of change triggered obtaining of control. Because you obtain control for the first time, it is your date of acquisition. At the date of acquisition, you will have to you apply your at acquisition journal entries, which includes recognizing goodwill for the first time and recognizing NCI for the first time. In this example, the second one, where you were a subsidiary and you become a IFRS 9, you're now doing the reverse. You are losing control, or not you losing, you lost control. Because you lost control, you no longer have a subsidiary, which means you can no longer consolidate, which means you can no longer have goodwill and you can no longer have NCI. So what does that mean? Your journal entries at the date of acquisition, your journal entries at the date of change in ownership is basically de-recognizing assets, de-recognizing liability, de-recognizing goodwill. Goodwill is also an asset, but I just specifically mentioned it, and de-recognizing NCI. That de-recognition comparing to what you sold it for will either give you a gain or a loss. That gain or loss, because it's not a transaction with the owners, it is a normal transaction, will be recognized through profit or loss. Very, very important. Okay, so that is the more complex one. So this is the difficult one. So this example we'll cover tomorrow. The loss of control. How do you account for the journal entries, and how do you work out the profit or loss from a group perspective? Remember, the parent will have its own profit or loss, because what the parent is doing, let's say it had 60% and now it's becoming 10%. What is the parent doing? The parent is doing the following. The parent is getting rid. So it's going to say debit bank for the 50% it sold. And then it's going to credit the investment at 50%. So Joe gets a profit or loss figure and then recognize that profit or loss. From the group perspective, we're also disposing. So the proceeds will be exactly the same as the proceeds in the parents' books, but the carrying amount is different. In the parents' books, the carrying amount was simply the 50% of the investment. But in this case, because we're losing control, the carrying amount is the loss of the entire subsidiary. So that's very, very important. You're getting rid of 100%. Remember, when you had a subsidiary, you brought on 100%, irrespective of how much you owned. But when you get rid of the subsidiary, the reverse is true. You get rid of 100%. As a result, the carrying amount of the subsidiary, from a group perspective, is applying consolidation principles, where the carrying amount from the group perspective is either using cost or using fair value in terms of IFRS 9. So therefore, the carrying amounts will be different. As a result, the profit or loss that the parent recognizes will be different from the profit or loss that the group wants to recognize. So just be aware of that. Very, very important. This example we'll cover tomorrow, which is quite, you need to keep your head straight. So it may appear difficult, but tomorrow when I show it to you, I hope it will come across quite simple. Okay, so remember, what is this course called? This is changing ownerships, but it is changing ownerships made easy. So we want to show you a way of how easy it actually is. It is not as complex as we may think. So this gain or loss that we're going to recognize, we need to recognize this gain or loss in profit or loss. Why? Because it is not a transaction with owners. So it is a normal business transaction. As a result, the gain or loss goes through profit or loss. Now we come to the last aspect. Okay, so this is the last we're going to cover for today. Tomorrow we're going to put it into action when we do a question paper. The last aspect is 3 and 4. I'm going to cover it together because it's the same thing. Is where you go from a big sub to a smaller sub, or a small sub to a bigger sub. Okay, so this is a transaction with the owner. So I'm going to explain it from going from a big sub to a smaller sub, meaning you are disposing of now I'm going to do it the other way around. You're going from a smaller sub to a big sub. So let's say from a 60% to a 70%. So you are acquiring a further 10%, which takes your interest from 60 to 70. So when you acquire a further 10%, before and after you are still a subsidiary, as a result is a transaction with the owners. Who are the owners? Parent and NCI. Remember, NCI is equity. They are the other owners. Okay, so they may be a group, but from our perspective, they are the other owners. So the parent and NCI. You're going from 60 to 70. Before you are a sub, after you are a sub. So that is a transaction with the owners. Who are the owners? The parent and NCI. By you going from 60 to 70, your interest increases by 10%. That implies the NCI is going from 40 to 30. Their interest is decreasing by 10%. Now, in such a situation, there will be a gain or a loss. Okay? Because this is a transaction with the owner, the gain or the loss cannot go through profit or loss. Remember, if you read IAS 1, they make it crystal clear that an income and an expense, if you read the last part, they will say it is a transaction that is a transaction not with the owners. Okay, so an income and expense, if you read it towards the end of the definition, it tells you it is a transaction not with the owners. So something can only go through an income and expense can only go through profit or loss if it is not a transaction with the owner. If it is a transaction with the owner, it can't go through profit or loss. In that case, it goes directly to the statement of changes in equity. That is why dividends paid does not go through profit or loss. Dividends paid goes directly to the statement of changes in equity in the column retained earnings. Okay, so that is the reason why dividends paid does not go, because dividends paid is a transaction with the owner. What makes it a transaction with the owner? Only owners can get a dividend. What makes you an owner? Owning a share. So an owner in a business owns a share, and only someone that owns a share can get dividends. So by default, that means a dividends paid is a transaction with the owner. As a result, dividends paid does not go through the income statement. It goes directly to the statement of changes in equity in the line item called dividends under the column retained earnings. And that is why when you put dividends in the income statement, they subtract marks because of their fundamental principle. So same thing over here. A transaction between the parent and NCI is an owner transaction. So any gain or loss cannot go through profit or loss. The gain or loss goes directly to the statement of change in equity. In this case, we don't take it to retained earnings. We have a separate column called change in ownership. The column is not required. You don't need to take it to change in ownership. But in the real world and from our perspective, from the academic world as well as the real world, they just have a separate column to keep track of it. But it's not required to go to a separate column. But for our purposes, it does go to a separate column called change in ownership. Very, very important. So the question is, how do we calculate the gain or loss? So the gain or loss, any gain or loss that we make from this transaction, whether we go from big to small or small to big, that gain or loss we make will go into the column change in ownership. Okay, so how do we calculate the gain or loss? It is as follows. In the same way you calculate the gain or loss on the disposal of PPE, how do we calculate the gain or loss on the disposal of PPE? The way we calculate the gain or loss on the disposal of PPE is simply as follows. Proceeds less carrying amount at the date of disposal gives us gain or loss. Now, the proceeds is what you sold it for, what you received. Okay, so let's say you sold it for 100,000 Rand. So you get 100,000 Rand, your proceeds. Your carrying amount is cost less accumulated depreciation at the date of disposal. So your carrying amount, let's say, is 90,000 Rand. So what did you do? You received 100,000 for something in terms of accounting that is worth 90,000. So you make a gain of 10,000. Now the same process will be used to calculate the gain or loss for this change in ownership. Proceeds less carrying amount gives you gain or loss. What is the proceeds? The proceeds is what you paid the NCI for that 10%. So remember, we're going from 60 to 70. So we had to give NCI some money to get that 10%. So the proceeds is whatever we gave the NCI as consideration for that additional 10%. Now, the question is, what is the carrying amount? In PPE, the carrying amount was cost less accumulated depreciation at the date of disposal. Over here, change in ownerships only comes as a result of being a group question. And since we are dealing with a subsidiary, this is a subsidiary we're dealing with. A subsidiary, the accounting treatment is what? Is consolidation. So that means we will work out total equity from a group perspective, meaning we're going to work out total equity from a consolidation perspective up until the date of change. So your carrying amount will be total equity from the date of acquisition up until the date of disposal. If you can picture your analysis of equity, so your analysis of equity will be at acquisition, since acquisition, and then current year. But you don't take the full current year, you take the current year up until the date of change. So that total equity, excluding goodwill, will be the 100% of the carrying amount of the subsidiary at the date of change. But remember, you're not acquiring 100%, you're only acquiring 10%. So we take that 100% multiplied by 10%, and that will give us the carrying amount of the subsidiary. That will give us 10% of the carrying amount of the subsidiary from a group perspective at the date of change. Now I will compare the proceeds you gave the NCI to the carrying amount of that 10% in terms of consolidation, and you compare. If you paid more, you're making a loss. If you paid less, you made a gain. That gain or that loss will go in the column change in ownership. The carrying amount, that is how much you will reduce NCI by. And that is basically how you account for a change in ownership. So I'll give you tomorrow we'll do the loss of control one. If we have time, I'll show you this one as well if we have time, so I don't promise, and then you can see how to deal with it. But that is just basically the high level overview that I wanted to cover with you. So if you have time to maybe watch this 40 minutes of this video, to just maybe write down some stuff for yourself and so forth, to familiarize yourself before you join the class tomorrow. So that when we cover it tomorrow, you actually have a basis for what I do tomorrow. I'll obviously still reiterate principles, but I'm not going to go into the details. So that's all that I wanted to cover for today. So if you have time, try to watch it. I'll send this video sometime today. Before we end, do you guys have any questions? If there's no questions, then you guys are good to go. No questions? Okay, so I'm going to end the lesson now. Bye-bye. I'll see you guys tomorrow. We will do an actual question on changing ownership. It's only one example, obviously. If I have time, I'll cover another one.